Hey everyone, welcome back to the channel. Today, we're diving into a question that puzzles a lot of investors. Why do US stocks seem to consistently outperform their European counterparts? If you've looked at the charts over the past few decades, the difference is pretty staggering. The S&P 500 has left major European indices like the Euro Stoxx 50 in the dust. So, what's really going on here? Is it just a lucky streak, or are there deeper, fundamental reasons behind this trend? Well, let's break it down. First and foremost, let's talk about the big one, technology. The US is home to the world's largest and most innovative tech giants. Think about Apple, Microsoft, Amazon, Google, and Nvidia. These companies aren't just American leaders, they are global dominators. Their growth has been explosive, and since they make up a huge portion of the S&P 500, they've single-handedly pulled the entire US market up with them. When you look at the top companies in European indices, you see a very different picture. They're often dominated by what we call old economy sectors, banks, industrial conglomerates, consumer staples, and energy companies. Think Nestlé, LVMH, Shell, and Siemens. These are fantastic, stable, profitable businesses, no doubt, but they simply don't have the same hyper-growth potential that we've seen from the tech sector. Europe missed the first wave of the internet and platform-based businesses, and the US reaped the rewards. This tech dominance is probably the single biggest driver of the performance gap. Next up, let's consider the culture of innovation and risk-taking. There is a certain mindset in Silicon Valley and the broader US business ecosystem that you don't find as readily in Europe. It's a culture that celebrates entrepreneurship, embraces failure as a learning opportunity, and pours enormous amounts of capital into disruptive ideas. The venture capital industry in the US is a behemoth, actively hunting for the next big thing and willing to place huge bets on unproven concepts. European business culture, by contrast, is often more conservative and risk-averse. There's a greater emphasis on stability, tradition, and incremental improvement rather than radical disruption. This doesn't mean Europe isn't innovative, it certainly is, especially in fields like engineering, pharmaceuticals, and luxury goods. But the scale of risk-taking and the sheer volume of capital flowing into early-stage, high-growth companies is just on a different level in the States. This environment acts as a powerful engine for creating new, high-growth public companies that eventually drive the stock market higher. Another key factor is the structure of the market itself. The US has a single, massive, unified market. It has one language, one currency, and a relatively harmonized regulatory environment. This makes it incredibly efficient for companies to scale up. A startup in California can sell its product to someone in New York with very few barriers. Europe, despite the European Union, is still a collection of different countries with different languages, cultures, and often subtle but important regulatory differences. This fragmentation can make it slower and more expensive for a company to expand across the continent. A German company wanting to sell in Spain and France faces more hurdles than an American company selling across state lines. This unified market advantage allows US companies to achieve scale and profitability much more quickly, which is a huge plus for investors. Let's also talk about share buybacks. This is a bit of a technical point, but it's hugely important. US companies are far more aggressive when it comes to buying back their own stock. When a company buys back its shares, it reduces the number of shares outstanding. This means that each remaining share represents a slightly larger piece of the company, which boosts the earnings per share, or EPS. A higher EPS often leads to a higher stock price. In the US, returning capital to shareholders through buybacks is a very common and accepted practice. In Europe, while it does happen, the focus is much more on paying out dividends. Dividends are great, but they don't have the same direct impact on boosting the stock price as buybacks do. Over the past decade, US companies have spent trillions of dollars on buybacks, providing a constant, powerful tailwind for their stock prices that has been largely absent in Europe. Now, let's look at the economic and political landscape. The US has generally enjoyed more robust GDP growth compared to Europe. Over the last couple of decades, a faster-growing economy provides a better environment for companies to grow their revenues and profits. Furthermore, while the US has its own political challenges, the European Union has had to navigate some very complex crises. Think about the sovereign debt crisis in the early 2010s, Brexit, and the ongoing geopolitical tensions on its eastern border. These events create uncertainty, and investors hate uncertainty. A more stable and predictable political and economic environment, which the US has arguably offered, is more attractive for capital. Another point is labor market flexibility. The US labor market is significantly more flexible than those in many European countries. It's generally easier and less costly for American companies to hire and fire workers. This allows them to adapt more quickly to changing economic conditions and technological shifts. If a new opportunity rises, they can staff up quickly. If a division becomes unprofitable, they can restructure more easily. In Europe, stronger labor protections and regulations can make companies more hesitant to hire, potentially slowing down growth and innovation. This isn't a judgment on which system is better for society, but from a pure corporate profit and stock market perspective, the flexibility of the US labor market is often seen as an advantage. Finally, we can't ignore investor sentiment and capital flows. Success breeds success. Because the US market has performed so well for so long, it attracts a disproportionate amount of global investment capital. When investors around the world, whether in Asia, South America, or even Europe itself, want to invest in stocks, their default option is often the S&P 500. It is seen as the safest and most dynamic place to put your money. This creates a self-reinforcing cycle. Money flows into US stocks, which pushes prices up, which attracts even more money. Europe, meanwhile, struggles to attract that same level of global investor attention. So, to wrap it all up, the outperformance of US stocks isn't a simple fluke. It's a result of a powerful combination of factors: a dominant, high-growth tech sector, a culture of risk-taking and innovation, a large and unified single market, aggressive use of share buybacks, stronger economic growth, and flexible labor markets. All of this creates a positive feedback loop that continues to attract global capital. Does this mean you should ignore European stocks entirely? Absolutely not. European markets are home to some world-class companies, and valuations are often much more attractive than in the US. Diversification is always key in investing, but understanding these fundamental differences is crucial for setting your expectations and building a smart, global portfolio. The trends that have driven US outperformance are deep-seated and aren't likely to reverse overnight. What do you think? Are there other reasons I missed? Do you believe Europe is poised for a comeback? Let me know your thoughts down in the comments. I read every single one. And if you found this video helpful, do me a huge favor and hit that like button and subscribe for more content just like this. It really helps the channel grow. Thanks for watching, and I'll see you in the next video.